This is a production of Cornell University.
I am going to start. My name is Brent Gloy. I'm the Department Extension Leader in the Department of Applied Economics and Management. I will be moderating the session today. Our first up on the program is our department chair. Lauren Tower is currently the department chair in Applied Economics and Management, and I think he's been on the job for 6 months now. About 6 months. So Lauren is our new chair, and we're very excited. Lauren's a production economist. He's been at Cornell for a while. I won't divulge that. I'll let him give you that information if he so chooses. But we're excited to have him, and he's doing a great job so far, and I'm just going to turn it over to him.
Well, good morning, and welcome to our Agribusiness Outlook Conference. Of course, my name is Lauren Tower, and I am serving as the current department chair of the Department of Applied Economics and Management. Bill Lesser completed his 5-year term as department chair June 30th, and he did an excellent job during that term, and I would like to thank him for the service that he provided to our department during that period. We have a good program for you today, but before we get to the main events, I want to update you on some developments in the Department of Applied Economics and Management at Cornell University. The quality of a department very much depends upon its faculty, and we've been able to hire some very good faculty this last year. Two of these are Miguel Gomez and Brad Rickard. Both of these individuals have been hired to do work in the horticultural area, and both of them have an appointment of 50% extension and 50% research. Now, I have their pictures up here on the screen, but they are on the program this afternoon in the horticulture track, and those of you who are interested can go see them in person during the afternoon. We've also just completed a search and hired Yura Lecointe, who is going to be joining us this coming fall, and she's going to be the Dake Family Assistant Professor of Marketing, and she'll be teaching undergraduate marketing courses and doing research. Her appointment is 50% teaching, 50% research. And we currently have a search underway for an assistant professor of finance. And we will be interviewing candidates this winter and spring, and hopefully we'll have somebody on board for this coming fall semester. We also have a number of promotions and awards that occurred during this past year. Chris Barrett, who does work in international development, particularly in Africa, has been honored for the Stephen B. and Janice Ashley Chair. Harry Kaiser, who primarily does work in commodity promotion, but has also been doing some work now in experimental economics, has been honored with the Gellert Family Professorship. And Hazem Dak, who is a professor in finance, is honored with the Peter and Stephanie Nolan Endowed Chair. These are new chairs that have been endowed by benefactors, and we're very thankful for these individuals. Eswar Prasad has been with us a number of years. He sits in the Talani chair, but he's been appointed as a senior fellow of the Brookings Institute. This is a policy think tank in Washington, D.C., well regarded, and generally is listened to during Democratic administrations. And so this probably will be a pretty active group starting January. He's also been appointed as a research associate for the National Bureau of Economic Research. Now, this is a group that determines when a recession starts in the United States, and they recently declared that our current recession actually began last January. Now, I've instructed Eswar to tell his colleagues that enough is enough and to call off this recession. You know, a year is long enough. Okay? David Ng has been promoted to the rank of Associate Professor of Finance and with tenure, and David has been honored with the recipient of the 2008 SUNY Chancellor's Award for Excellence in Teaching. And Anjali Apponen has also been promoted and tenured, and she does her work in strategy, particularly the impact of new technology in the economy. Now, the management team for the department, of course, have changed. I've become the department chair as of July 1. Brent Loy is continuing as the department extension leader. Ed McLaughlin is continuing as the director of the undergraduate program. And I stepped down as the director of the graduate field, and the graduate field faculty elected David Just for that position starting July 1. We have 2 external reviews coming this winter. We have a university department review, and the review team will be on campus January 25th and 27th. This is a review mandated by the university for every department every 10 years, and it's been 10 years for us. And we also have the AASCB review of the undergraduate business program on February 8 and 10. This is the board that accredits our undergraduate business program. Also participating in this business accreditation process is the Johnson School of Management and also the graduate program in the hotel school. Now, we've put together some self-study reports and documentations for these reviews, and that has allowed us to basically document our productivity. Now, what we do here, of course, at a university is we teach, we do research, and we extend knowledge. And so I have 3 metrics here of our productivity in these 3 areas. You can see that during the last 3 years, we've taught over 60,000 credit hours. And basically at an average of 3 credit hours a course, that represents 20,000 students. Now, some of those students have taken more than 1 class. Hopefully those students haven't taken the same class to represent those credit hours. Our faculty and staff have presented 693 extension meetings and workshops during that 3-year period, and we've published 230 referee journal articles. Something about our student population. Fall of 2008, basically we currently have 661 majors in the department, and we have 29 double majors from other majors within the college. We have a significant number of minors now, 143 within the college, and 89 from students from the engineering program. The freshman class included 98 individuals. And this individuals came from a pool of 1,268 applicants. And this is a 20% increase over the previous year, and basically gives us a really low admission rate of 12%. And we have a 65% yield rate. These are very bright individuals. Their median SAT score was 1420 out of 1,600. We also have transfer students, both from within Cornell and external to Cornell, and you can see that together they're about 100. And these are primarily sophomores, sometimes juniors. So you can see that although we only admit 98 freshmen, and we do that because of the ceiling on the total number of freshmen that can be admitted to Cornell because of our infrastructure limitations on classrooms and beds. But we end up graduating usually, and we will graduate this year, probably well over 250 students. We also have a very good graduate program, and we currently have 78 graduate students in that program. These students come from all over the United States and also around the world. Our undergraduate program is highly ranked, and that's one reason why we're getting all these applications. The Business Week ranked our program last spring as 4th in the country. U.S. News and World Report ranked us as fall 11th in the country. we would like to be in the top 10 there and maybe next year. Of course, the Business Week is collecting data now for their ranking that will be released this coming spring. We have a number of challenges this coming year. Our department, the college, and Cornell University, of course, are facing significant budget challenges, but then who isn't? After our department and accreditation reviews this coming winter, we will be able to we will assess our strengths and opportunities and make adjustments in our programs. But whatever adjustments we make, I can assure you that we will continue to provide a world-class education to our students, and we will continue to serve the agribusiness sector of New York State. Thank you, and I look forward to the rest of the program, as I'm sure you are.
Thanks, Lauren. Today, we're pleased to have Steve Kyle back with us. Steve is an associate professor in our department. He works in the area of macroeconomic policy and has worked both in the United States and in low-income countries. He teaches a introductory macroeconomics here at Cornell and is a very highly regarded instructor in that class.
I always start with grading myself on my prediction from last year so you can see what I did right and what I did wrong. And this year I have good news and bad news. The good news is that my predictions from a year ago were pretty good. And the bad news is that my predictions from a year ago were pretty good. I was pretty pessimistic last year, and that was entirely appropriate. I said last year that GDP growth would be somewhere between 1% and 2% unless the credit crunch got really ugly. So what happened, in fact, was that GDP did grow at 1% in the first quarter, 2.5% in the second quarter. The latest estimates are that we have negative, well, this shows a negative 0.3, but it's been revised to negative 0.5 in the third quarter, which comes out to about between 1% and 2%, and then the credit crunch got really ugly. So we don't know what's going to happen in the fourth quarter, but I have no doubt that that red line is going to continue south, and we will see more negative growth in the fourth quarter. So I got it pretty well on the GDP growth overall. My next prediction was what was going to happen to interest rates, and there I said that the Federal Reserve was going to keep lowering interest rates, and that is exactly what they did. Ben Bernanke et al. Have lowered them now to 1% on the federal funds, which is itself sort of notional because in actual fact, the interest rates we see in the market are lower than that. In fact, last week, the yield on 3-month treasuries was 0.005%. Now, I call that zero. We can round that off to zero, and I'll have more to say about that in a little while. But this was a prediction that was pretty easy to make. When the economy is heading south, the Federal Reserve lowers rates. It's not a time to raise them. And they did it pretty steeply too, as you can see right there. If you look at my prediction for inflation, what I said last year, and by the way, let me just say, I always put a summary of my predictions on my website. This year it'll go on probably next week. I'm going to be out of town the end of this week. So you can look and see what I said. I leave it up there so you can grade me. And see if I'm getting it right or not. This is an easy one for me. I'm just talking about things that haven't happened yet, so nobody can really seriously say you got it wrong to my face, except what happened a year ago, and then I can always waffle and tell you why, which I'm about to do now. Inflation, I said, would be about 5%, which looked okay for a while, but then gas prices went sky high in the spring and summer, and my prediction was looking very bad. You'll see that's up around 12% at an annual rate. Since then, though, prices have gone down, and in fact, they may even go negative, which means that my estimate of 5% overall for the year isn't so bad, but on the other hand, it's not for the reasons I thought, so I'll take that as a freebie. I got it right. Every now and then you throw a dart and it hits the board, and you don't know why, but hey, I'll take it. on another point, looking forward, inflation isn't something we really need to worry about. When demand is as down as it is right now, and gas prices and oil prices generally are as well, we're not going to see inflation going forward. The exchange rate has also strengthened quite a bit, and that also helps keep prices down. Speaking of the exchange rate, I got my prediction right last year. And I did say a year ago that I wasn't sure that my weak exchange rate prediction was good for the next year. But then I went on to worry at some length last year about what would happen to the exchange rate when Ben Bernanke lowered interest rates. Well, he did lower interest rates, but the US dollar actually has strengthened. So rather than people fleeing the dollar because of lower return on dollar assets, people are so nervous about what's going on in the world that they have been putting their money into treasury assets because they are the safest thing. And you know, if the US Treasury goes down, if the federal government goes down, then it really won't matter what kind of assets you have. You probably want to have a shotgun and go deer hunting because that's where we'll be if the federal government collapses. I say that a bit facetiously, but I'm not promoting or discouraging deer hunting, by the way. All right. So I also said last year that the federal deficit would be huge, and that is an understatement. It is going to be tremendous. We still don't know how big. $500 billion is what it looks like it's going to be right now, and probably bigger next year, although I'll talk more about that in a little bit. But certainly my projection for big and growing federal deficits was right. I also said last year that one of my big concerns was the housing market, and that turned out to be a really good prediction, although it wasn't much of a prediction. It was already bad last December. But if you look at graphs like this one, this is housing units started. You don't need to be an economist, and this is why I say I don't use computational models. I call that cliff diving. If you look at that, that's a trend, folks. That is a bad trend, and we see now housing starts at a level that we haven't seen since the early 90s, and that's with a substantially bigger economy and population now. We can look at, if you want a little foretaste of gloom and doom, which I'm already haven't been the most cheerful in terms of what I've been projecting. Here we have private construction spending, and the red is residential, and the blue is non-residential. Typically, we see non-residential trailing residential. We usually see that red line start to go down before a recession really hits, which indeed it has right here. That's, you know, private housing of 1 to 4 units. Non-residential, which is office buildings, malls, so forth, tends to go down when the recession hits, and we're just starting to see that happen. So if you think the real estate market looks sick now, it's going to look sicker still in terms of residential housing, and we're going to get an additional hit in commercial as that starts to go down as well. So things like marginal malls will close down, office buildings will have empty space, and if you look at how optimistic the builders themselves are, here's another graph of sentiment of the National Association of Home Builders. They are not happy. That is as low a reading on this index. This is basically analogous to the Consumer Confidence Index, but it's how confident home builders are of their business in the year to come, and this is the lowest reading we've ever seen, and sinking like a rock even from that low level. Okay, so that is, that's as cheerful as I'm going to get. My next, oh, by the way, I should have said this at the beginning. I hope you, if anybody wants to follow me along, there is a blue outline of my talk, which you can pick up at the back of the room afterward if you don't have it already. But I usually, in my talks, then go on to business cycle indicators of where we are now. And as Professor Tower mentioned, the National Bureau of Economic Research called a recession I think it was last week, if I'm not mistaken, and they said it started about a year ago. That was pretty quick for them. Sometimes it's as long as 2.5 years before they can make up their mind that those lines turned around. This time it was pretty clear. If you look at all those graphs with everything going up and up and up and then falling off a cliff, you know, it's sort of a duh, you know, you don't have to be a rocket science economist to figure out that things have turned around. On the other hand, many of us don't wait for the NBER to decide that it turned around. And I was one of them. I used the recession word last December, and I wasn't alone in that. There were quite a few of us. But if you look at one of the biggest indicators, civilian unemployment rate, you can see here that it turned around and has been climbing steeply over this past year. It had already started to turn around at the end of last year, but hadn't really made its big move until now. This is pretty unmistakable, that we're now at 6.7% unemployment and still climbing. This line shows no signs of turning around. Other indicators, and these are ones that the NBER uses. So just imagine, and this is really what they do, they have a bunch of economists sitting around a table, or the virtual table nowadays, if they connect themselves by video link, and they're looking at these kinds of graphs. And so what they did last week is they looked at this one and the ones to come and said, yeah, I think it turned around back there somewhere. So it's good work if you can get it, but not really hard to do. They're not using computational models either. The Industrial Production Index is one that they also use. On this one, the blue line is the actual value for the index. The red is percent changes. You can see that this has now turned south. It is growing negatively, and if we were to have the early indications of what this is going to do in the near future is that it's going to head further south. Factory orders are down, which means that factory production from here on out is going to grow or even shrink less. It's going to grow less than this. It's going to shrink even more. And you can see here what happens. This was the mini recession we had in 01 and 02, right after the last, the 2000 election when Bush first came in. There was a mini recession. And that meant we got down to -4%. That was not a major recession. I expect this to go way down below that. You can expect that to go pretty far down. If you look at what, and continue on with my indicators of our current situation, you have here retail and food service sales. This is what people are spending money on. And here again, you can see a clear turnaround where consumers have started spending less money. This rate of change here went negative sharply over this last year. And you can see here that it didn't even, I mean, this is something that's fairly unprecedented in recent history. That recession in 01, 02, we just saw this line flatten out a bit. Even if you were to take this back, I actually should have extended that back into time a bit more, but it pretty much flattened out during recessions earlier in the 90s and late 80s also. We haven't seen a drop like this in quite some time. So that is a bad thing. And what do the consumers think is going to happen? Well, we have that consumer confidence index, and that is what it looks like. The reports on this were that the reading is very low. It's at 38. What they didn't tell you is that that is the lowest reading in the history of this index. Never before have they had a reading that low. So the consumers, and that's all of you folks, so you can take your pulse right now. Maybe I've slowed it down or sped it up depending what you have your money invested in. But the consumers are reported to be very unhappy. And this has some important ramifications for what we should do about all of this, which I'll come to in just a minute. Further indications of where we are, personal income still has not turned around drastically. The growth rate has fallen. It does look like it's flattening out there a bit. It is safe to say that that is likely to stagnate as unemployment continues to rise, which I fully expect that it will. But it is not going to grow very quickly in the future, and could even fall if unemployment gets high enough. Again, if you look at the history of this, we see it flatten out a bit when there's a recession. We don't often see it fall, at least not in recent history, but it could well do. An indication, one more indication of how consumers are feeling is Christmas spending plans. And you can see here that we have, well, 98 was a great year to be looking under the Christmas tree. Since then, we've been in single digits, plus or minus. People have been more or less spending the same amount of money, which actually isn't a good thing, folks, because that's pretty much flat, right, as we've seen GDP growing, which means people aren't getting the wage earners, the wage bill. Most people haven't been getting that much. But then that, too, falls off a cliff this year. The surveys they've done of what people plan to spend for Christmas this year are half of last year. And if you look at what the reports are from the Black Friday, so-called, after Thanksgiving sales, the reports I heard were that it grew 3%, which is, that doesn't sound too bad until you realize that's in nominal terms, and in real terms it's flat, and that is with huge sales and lots of promotions. Sales since then have stagnated, and I've tested it out myself at our local mall. It doesn't look particularly crowded. The so-called Cyber Monday, the Monday after Thanksgiving, for online sales actually fell a couple of percent from last year. So indeed, consumers are looking at spending less money this year, and I'm in that boat too. I don't think that prices are going to go up. Prices may well fall. Why rush out to the store? Why buy anything? Be happy you have a job, folks, if you do, and don't quit. Not yet. Okay, one final indication of where we are right now. Household debt service. This is something that I have often said really makes me nervous about American consumers. This is, if you add up the debt service that people have and compare it to their income, a normal range is somewhere between 10 and 12. And that's what you can see back in history here. This goes back to 1980. Where we got by last year was well above 14, and it is just started to turn around. You couldn't get a loan now if you wanted one. In my opinion, you'd be probably insane to want one. You should not want to go more into debt. But this is a problem because even if people reduce the amount of debt they have, the denominator of that, their income, is going to be heading south also. So we're going to have that numerator chasing the denominator south, and so far the debt has gone down faster than the income has, but there's a cheery thought for you that it might not fall as fast as you would think if people lose income as well. Okay, that's the current situation for indicators. Oh, and I do have inflation on my list also, but I already mentioned that I'm not really worried about that. Inflation is, if anything, negative right now. With no demand out there, it's hard to imagine that we're going to see prices going up, and possibly they could even go down. The current stance of the federal government in terms of policy is that Ben Bernanke has lowered interest rates to 1%. As I mentioned, they are in the market even lower than that, which means he is out of ammunition. There is no more stimulus to come from monetary policy because you can't lower interest rates below 0. He can engage in some unorthodox things, and they've been talked about. For example, buying assets, longer term assets. The Fed could get in the business of buying back 30-year bonds or other longer run assets that typically they never do. But even that would be kind of extreme. It's safe to say that we are not going to see much more out of the Fed in terms of stimulus. We can't look to them for what we might want the government to do. We're going to have to look to fiscal policy. And where is fiscal policy? It is very much in deficit. We have a $500 billion deficit this year, probably, and it looks like it's going to get even bigger. There is one silver lining to this cloud, though. If you borrow a lot of money and interest rates are 0, hey, that's pretty good. I could go for a 0 interest loan. That means that the federal government is going to be more or less on a free pass, at least in the very short run, and insofar as they fund their debt at the short end, they're going to be able to borrow very cheaply. So that stimulus that we hope they're going to do, at least I'm hoping they're going to do, I would ask for a show of hands, but let me just plunge ahead anyway. I hope we all want to do it. At least I'm going to convince you by the end that we want to do it, is that we are going to want to see them doing that, and it's, at least in the short run, not going to be all that expensive. All right. So what do we do about this? This is, as various people have said, a major economic problem. I think it's fair to say that we want to have a stimulus. Most economists would agree on that. My own opinion, and this is, I teach intro macroeconomics, is this is almost exactly a textbook case of what Keynes was talking about when he wrote his general theory and was worried about the Great Depression. I'll come to my comparison of this with depressions in the past in a minute in my depression tour of 2009. But let me give a little economics lecture here. We have, and this is as hard as it's going to get, so, and all of you students of mine out there, you can furiously write this down. You'll be on the exam. It'll be a quiz for all of you. All right. There is a big gap in demand, folks. We have consumption dropping like a rock. I've shown you the graphs. People are scared. They don't want to spend money. Personal savings, which has been hovering around the 0 point for a while now, is now getting positive. People are starting to realize, oh my God, things are not going to go off happily forevermore. I better save at least a few pennies for the future, which means they're not going to consume. Business investment is also in the tank, because why would business invest if people aren't buying anything? There is no question of spending money for new capacity because they're not even using all the old capacity. They're not even worried about building up inventory because their inventories are high to begin with. So you can't count on consumption and you can't count on investment. There are going to be drops there, big declines. You can't count on the foreigners either. They're also, unfortunately, in sync with us in their business cycle, and so exports are not going to grow either. That leaves G, that's government. If we want to get the economy moving again, there is only one game in town, and that's the government spending. And so, okay, that's a stimulus package. What kind of stimulus package? Well, here's some notes on that. I think one thing we do want to do is make it soon. We want to do this as soon as we possibly can. I think it was unfortunate that the $700 billion that was voted in a couple of months ago has only been half spent, and the Treasury Secretary says they're not even going to try and spend it. The second half of that they're going to leave for Obama to do. I wish they wouldn't do that. We need this help right away. And in order to prevent things from falling any more than they already have. We want a stimulus to contribute directly to spending. And this has some important ramifications for what kind of stimulus we should have. One of the things that is often cited and is a good idea is to extend unemployment. People who are unemployed, almost by definition, will spend the money you give them right away. And with unemployment benefits running out, it is something that they need. So even if you abstract from humanitarian reasons, these people do need the help, or political reasons, give them money so they'll vote for you if you're a politician, the macroeconomy needs this because they will spend it right away. Aid to state governments, and may I put in a plug, especially New York State government, and especially the education budget of New York State government, is also a good idea. State governments always spend the money right away. If you give them the money, and state governments are hurting, perhaps the biggest example in the news is California, and my sympathy is not particularly great for them because it's a self-inflicted wound, but nevertheless, state governments will spend the money right away. So if what we're looking for is something that will happen quickly, then giving money to state governments is a good plan. They have lots of programs and projects that they are going to cut back if they don't have the money, and they're not going to have the money. So that's a good thing to do. Aid to already in the pipeline projects, that is another thing that we see proposed, and it's a good idea. infrastructure projects because we want to push money out the door. So we're really not looking for things where we have to go through the feasibility, the appraisal, the environmental impact, and it doesn't really start happening until a year and a half from now. That's not what we're looking for. We're looking for things that are already approved, that can be done right away, and construction projects are often very big on this. Road building, bridges, fixing schools. Many of them, my kids' school district, one of them, have plans on the books. They know what they would do if they had the money. Give it to them, because it's very labor intensive, will employ a lot of people, will spend the money right away, and also has the benefit of being good for the economy in the long run. These various infrastructure needs are things that we have been putting off, but they are going to need to be done at some point. Let's do it now because we need the boost. What we don't want to do is to first do this in a piecemeal way. We want stimulus, shock and awe. We want there is a psychological aspect to this too. We want the people in the economy to be jolted out of their pessimism, and they can always come and listen to me talk if they want to. Thank you. I instruct my classes, one of the requirements in my class is to laugh at my lame economist jokes. All right, so we don't want to make it piecemeal. We don't also want to think that tax cuts will necessarily be spent. In normal times, you could do a stimulus in terms of spending, or you could do it in terms of tax cuts. Right now, if you gave a lot of people a tax cut, they'd save the money. That's what I would do. I'm not going to go out and buy a big ticket item. This is not the time to go out and buy the big flat panel, the car, replace the refrigerator, or whatever it is. So it is not the case that you can expect tax cuts to necessarily be spent. This is important because there is a knee-jerk reaction on the part of many in Washington to think that, okay, tax cut, we want a stimulus, let's do a tax cut. And ordinarily I wouldn't object to that on macroeconomic grounds, but it's not likely to work all that well right now. We need to actually get the money spent, and that means spending it directly. It's also important not to imagine that incentives to lend would mean actual lending. So when we see this financial bailout of the various institutions on Wall Street and in Washington, I'm in favor of that. We don't want some of these institutions to go down if in fact they are solvent in the long run. But that doesn't mean that these banks are going to rush out and lend money. I see a lot of complaints in the press about the Bank of America and Citigroup not lending money to people even though they've gotten a bailout. And my attitude is, yeah, you're right about that, but what did you expect? These institutions have seen a major hit on their balance sheets. They have seen a lot of things that they thought were assets, mortgage-backed securities and other derivatives, suddenly become either worthless or go into a state where you don't know what they're worth, and so you can't actually sell them, and so you can't really account for them. They are trying to rebuild their loan loss reserves. They're trying to rebuild their capital base. That means they don't want to lend. And even if they did want to lend, why would business want to borrow? Nobody's buying anything. So this is, in effect, pushing on a string if we try and promote growth this way. We need to pull on the economy by spending the money directly and not hope that providing people with incentives is going to do the trick. We also don't want to implement permanent programs of spending unless they contribute to long-term productivity. That's why it's a good idea to do things like infrastructure projects which have a finite lifespan. It is going to be a tricky thing, but Mr. Obama is going to have to try and promote the impression that though he is spending money like a drunken Latin American dictator in the short run, that it's all going to end as soon as the stimulus need is gone and we're going to return to our fiscal senses in a few years. Now, I am not one who always likes to see more spending and who is a la-di-da, deficit don't matter type of guy. I don't like it that we're starting this from this point with ourselves already massively in deficit. But it is simply the case right now that if we are looking at what kind of a deficit we need, of a program we need now, we need to spend the money. We need to get it out the door. You want to know how much? I think that what we've done so far, I don't object to it, but it's really just a pittance. What we have from historical examples is how we got out of the Great Depression. There, we had deficits as high as 20% of GDP. Actually, they even got higher than that, but certainly by the time they were 20%, we were out of the Great Depression. That was huge. What that would be now is something on the order of $2.5 trillion. I don't necessarily think we need something that big. That was more than enough, but it is much worse to do too little than too much. We don't want to do not enough and then have to go at this again. If you are worried about doing too much and the economy getting too stimulated, remember, interest rates are at 0. And there's plenty of scope for the Federal Reserve to cool things off by raising interest rates. I mean, they could multiply them by 10. And then what's 10 times 0.005? I never try and do arithmetic in front of a crowd. It's still not a very big number, suffice to say. They could raise them 5 points, and then we'd still have interest rates at 5%, which is high, but not ridiculously high. So there is a lot of room to cool things down if that's what needs to happen. We can always scale things back, but we want to have this done right the first time around. My own view is we should be looking at spending something on the order of perhaps as much as 10% of GDP, just to make sure we get this right. We can always cut it off later if that looks like it's not needed, but we don't want to do too little. That's 10% is something like $1.3 trillion, something like that. Even if we do that, and some people are going to be saying, oh my God, how can you do this? It's very important not to slip into what I call Hooverism. Herbert Hoover was president in 1929. We had a big stock market crash, and he spent the next 3 years doing almost nothing about it. Certainly, he didn't do any kind of a stimulus plan. He tried to balance the budget. And that is what a lot of people in Washington reflexively are trying to do now. They can't wrap their minds around the idea of a massive deficit on purpose. Lots of red ink. Do not pay as you go. Do not fund the new spending with new taxes. Do not cut spending elsewhere in the budget to fund the stimulus package. Spend the money and spend it on top of what's already been done. That is going to be something that is going to be politically difficult to do, although actually a politician's dream, I would think, is to come into office and have all of the economists of the country, or at least many of them, saying, spend money, spend it everywhere, spend lots of it. If I were a politician, I would say, gee, thanks guys, I love that advice, and please won't you sit on this blue ribbon commission that I'm going to point 18,000 TV cameras at so you can tell me why I should give money to every single constituent out there who might ever might ever vote for me or might not. 10% isn't a bad estimate given some of the estimates from Wall Street about what our current gap is. The Chinese actually are up there. They announced a 20% of GDP deficit in order to stimulate their economy because for them 9% growth is just too low. Oh well, we are not in that situation. Another question that arises, and this is something I've talked about in the past, is if we're borrowing this much money, who is going to buy all that paper? And the answer, we hope, is all of these people in the United States who have newly rediscovered savings, but also we're going to need a lot of money from the foreigners as well, and there is a potential pitfall there. If you look at who's been buying our debt and in what form, this graph has some interesting stuff on here. The blue is agency debt of the United States, and a lot of that is from Freddie Mac and Ginnie Mae, also some other agencies, but the demand for that, for obvious reasons, has tanked. I have another graph which also shows corporate paper, and that has also had a pattern similar to this. The green is treasuries. So basically, the investors have abandoned all sorts of paper except for treasury obligations themselves, and we should hope that they will keep on doing that. That is one of the big reasons why it's important for Mr. Obama to communicate, I'm going to do a big stimulus, there's going to be a lot of debt, but no, it's not forever, we are going to come to our senses. I also one thing that's important to look at here is who is it that's going to buy this. Over the past 5-10 years, the two big purchasers have been the Chinese and the oil exporting countries. We can expect the Chinese to continue. They have just gotten a bonus on their balance of payments because the price of oil went down for them, just like it did for us. The price of all the raw materials went down. So they do have room to keep buying our paper. The OPEC countries don't. When the oil prices went very high, their spending went high, and in fact, a lot of the OPEC countries now have a problem. Their spending is in excess of their revenue because the price of oil was, what did it get up to? Almost 150 a barrel, or maybe even higher than that, and now it's in the 40s. So they are in deep trouble, and we can't expect them to keep buying the paper. All right. I have another item on my outline called tax reform, and I have that on there because politicians always want to talk about it, and my opinion on that is please, please be quiet. We don't need tax reform right now. In fact, I hope they don't cut taxes to any great degree, precisely because we are going to need to have more revenue sources when the need for a stimulus is over, and I would hope they don't make that task any more difficult than they already do, than it already is going to be. Yes, sir?
How much damage would it be to take the $1 million up income and reform that into more tax?
Take $1 million of
Ordinary income, campaign, whatever, anybody that got, was the beneficiary of Bush tax cuts gets nailed now, how much damage would that do?
It depends how much money you think. Well, there's two things. Macroeconomically, I don't know if it would do that much because I don't think those people are going to be spending a lot of money anyway. But there is a psychological and a political angle to this as well. I don't think right now is the time to get into an argument about raising taxes. I also think that it would be a mistake to use up political capital on that right now. These tax cuts are going to expire in a couple of years anyway. My own view, and that's just my own personal opinion, is let that happen. There's other bigger fish to fry in political terms, and I hope they don't waste it on that. So we'll see what happens. But again, I don't think the macroeconomic issue would be that huge because I don't think those people are going to spend that money anyway. All right. So next up is this like 1982, or which is the last big recession we had, or 1932? It is somewhat like 1982 because that was a recession that was sharp, and the government immediately started to do what it could to combat it. We had interest rates at that time that were in the teens, and the Federal Reserve started aggressively lowering them right away. We also had Ronald Reagan's massive tax cuts coming into place in 1982, and so we had stimulus from both the monetary and the fiscal side. Insofar as that is true, it is like 1982. The other comparison is with the Great Depression. Now, it's not like the Great Depression because unlike Herbert Hoover, the government is moving to act right away. We know what to do, unlike 1932, when all these ideas were experimental. But it is like 1932 in that we are now looking at a situation where we have no monetary policy bullets left to shoot. We already have interest rates at 0. We can't look for help there. It's up to spending to pull us out of this. And I hope we can do it in as big a way as we can. How long will this recession last? Well, I would say longer than 1982 because we are in deeper trouble and we have more limited means to deal with it. But we're still looking for a bottom in the housing market. Just a quick graph on that. If you look at housing prices right now, we are still much less. We're still not back to the normal historical range, so we have to see prices falling still more in order to get there. If we look at what's going on in the stock market, and here's my most cheerful picture of all, we have now the tech crash of 2000 and 2002. We saw stock prices fall in half, and it took about 2 years to do that. It didn't take as long for the 73 oil crisis. We also saw stock prices cut in about half. We have seen stock prices cut in about half for us, and it took didn't take very long at all, less than a year. And for a really cheerful line, we have this light gray one, which is the Great Depression, where stock prices fell by 90%. I don't know how long this is going to last, but let me get to my predictions. I would predict that if things go very well, that is to say, we get a big stimulus, appropriately structured, in place quite quickly, nothing else bad happens, and everything falls our way, 2009 is going to be a bad year, and we won't see any growth at all. That's my optimistic end of my forecast. If things don't fall our way, we don't get a good stimulus package, it's not well structured, it doesn't work, or some other external shock hits us, things could be truly awful. And I will give the center line of my estimate as somewhere around -1% or 2% growth. It's going to be a bad year. That means unemployment is going to be easily, it's now 6.7%, it's easily going to hit 7 or 8. I wouldn't be surprised to see 9%, though unemployment tends to be a lagging variable. If things get really awful, we could even see 10%. Although not necessarily next year. It could be a little bit later that we start seeing numbers that bad. I am not worried at all about inflation. Prices aren't going anywhere. As far as stocks, this cheerful picture here, get out your dartboard. We have price earnings ratios now that are back in historical ranges, which is, okay, 25 when things are booming and in the high teens when things are normal, and down around 12 or 13 when things are at the bottom. The only thing I could say with any confidence is anytime we're in a situation like this, we have very much increased volatility. Where the bottom is, I don't know, but I am happy not to own lots of stocks at the moment. Where the exchange rate will go, I couldn't tell you. Right now it's in the 120s. It will tend to go down if investors are worried about us floating huge amounts of debt. On the other hand, interest rates can only go up, which will tend to support it somewhat. So I don't expect it to go strengthening anymore, but the downside on the dollar is somewhat limited by the fact that interest rates can only go up instead of down. And with that, I think we have time for at least a couple of questions, so let me pause. Yeah.
Other than seeking and receiving federal aid, what role should state governments play in all of this?
Well, state governments are caught in a bind. Their receipts are going to go down. State governments are typically very reliant on sales tax, and depending which state, some of them are reliant on income tax. Neither of those sources is going to be particularly healthy in the coming year. So they're going to be looking for things to cut, except if they get federal aid, then they won't cut so much. So it's going to be a question of choosing what to cut and what not to cut. We can hope that they will cut things that would stimulate the economy less, but state governments tend to spend money on things which are immediate spending priorities anyway. So that's one of the reasons why I'm hoping that a stimulus will include aid to state governments.
Comment on potential for falling to deflationary situation?
Well, it is, a deflationary cycle is possible, but I'm not at this moment worried a lot about that if the stimulus package is big enough. The federal government does have it in its power to prevent that if they do a big enough spending package. On the other hand, if a deflationary cycle did happen, all of those people who are in debt over their heads will be in deeper, deeper trouble, because the dollars they're going to have to pay back are going to be worth more than the dollars they borrowed. It will exacerbate the real problem of debt and unbalanced balance sheets, which is at the core of a lot of the issues right now, that people owe more than the underlying assets are worth.
Is there a potential that could happen?
Well, we're already seeing prices. I think some of the readings on the CPI were already negative. So it's not as if that's an unimaginable thing, but I wouldn't put that in the realm of probability right now, given what I'm hearing out of Washington and what they intend to do. If they do succeed in doing it, I think Mr. Obama will have a honeymoon period when people will the Congress, which he'll have mostly on his side anyway, will mostly give him what he wants. So I think I'm not really worried about that. Yeah.
I would say it's fair to say that the recession we're in now is much due to our self-inflicted wounds and subprime, et cetera. But our recovery, how much is that connected to the world issue, specifically where we move in China? Also in the recession, they happen to come out there. How close to that?
Okay, well,
How will that affect our
well, the first statement on that is that it's not just subprime that's our problem. The latest figures are that 3% of mortgages are in foreclosure, 7% are delinquent, which means 10% of all mortgages are either gone bad or heading that way. 4%, they say, of that 10% is not subprime. So this is not a subprime problem only. And for another cheerful thought, Credit Suisse just this week predicted that by 2012, 20% of all mortgages will be in foreclosure. So there's a happy thought for you. But what about the rest of the world, and will they pull us out of this? No, they won't. I think it's up to us to pull them out of it, actually. And so I'm hoping that's yet another reason for us to want to have a big stimulus package. In the past, there have been some recessions, the one in 2001, for example, when we were not exactly in sync with the Europeans and other parts of the world, so we could get some boost on exports from them. We're not going to get that this time, and so we need to lead the way. We are the biggest, we are actually the epicenter of the problem, so we're going to have to fix it here. Yeah?
In the past, we have had some things where we reinvented the wheel, if you will, big inch World War II, and then Eisenhower's interstate program and NASA. And I'm wondering if you think there's any future in electric cars and Midwest wind power and so forth as a good way to cut our imports.
Well, I certainly hope that we do the research necessary for alternative energy sources. OPEC was in the news cutting production again this last week. They are not going to help us. They don't have our best interests at heart. They have their own best interests at heart, so I'm all in favor of that. However, that is not the immediate macroeconomic stabilization that isn't going to be big enough to make a big difference in the short run, although I hope they do it. I mean, we've heard proposals. I think the proposal I heard was $15 billion in energy research, which is fine, but that's a very small share of the more than $1 trillion I'm talking about doing as a stimulus package. Yeah?
Will increased savings be part of the problem or part of the solution?
Increased savings are part of our, in the long run, we need it. I think the party was due to end at some point. We can't forever spend more than we earn, which was what the private sector was doing for the last few years. In the short run, however, that makes for a gap in demand which the federal government has to fill. And if I had my druthers, they would fill it with spending on capital assets like roads, bridges, schools, etc., productive things. But in the short run, the retrenchment of the consumer, which has long been needed, doesn't help our imbalance at the moment. Yeah.
There's already been one economic stimulus package that was done. What do you think the second one will be more successful?
The first one was only half done. They didn't even spend half of what they did appropriate, and it wasn't big enough. So I think what they need is a much bigger one. No messing around this time, spend the money. We know that it can work. It worked to end the Great Depression. It worked to end the recession of 1982. We're not reinventing any economic theories here. We know it can be done. I certainly hope they don't reinvent World War II, but it's not necessary that this be military spending. There's nothing magical. I mean, my preferred type of spending is labor-intensive infrastructure investment, but as some economists have said, it doesn't really matter what kind of spending, just spend the money. And from a macroeconomic point of view, in the short run, that might be true, but in the long run, we want to use it as productively as we can. Yeah?
The opportunities for stimulus spending is school buildings. By local school districts, and yet from a school district point of view, it's property taxes that would be paid those, and not all these foreclosures that we're dealing with. Do you have any suggestions on
Well, if the school district is floating a bond to pay for infrastructure investment, yeah, it is property taxes that'll pay that back. And my own taxes are part of that. But what I'm saying, well, I didn't realize I had such a conflict of interest, is don't raise taxes to do this spending. Have the federal government step in with state aid to do it without raising taxes to offset it. So that would be something that would help school districts actually, rather than hurt them. Yeah. One more, I'm told. You're the end.
From a New York State perspective, if our biggest challenges in terms of economic development are taxation and energy costs, might this have a silver lining in forcing we've already seen the energy cost reduction happening. Might the sort of starvation of state government force a change that we've looked for a long time also?
Well, in terms of energy, not necessarily, because being an economist, I think that the alternative energy sources are much more viable when oil's expensive and the price just dropped. Actually, I wrote an editorial for Scientific American last month saying they ought to have a variable levy on oil to keep the equivalent price at 80 bucks a barrel. Oh my God, I wanted a tax. But that would keep the alternative sources. I mean, basically what the problem is for alternative energy source people is they don't have any solid target to aim for in terms of at what point does their investment break even. And if they had some sort of a certain floor to oil prices, they would know what they were, when they had reached viability, and it would be much more possible to do those investments with confidence that you would make a profit on them. So that is, I guess I'm. Can she please?
All right.
All right. Okay.
Who is getting rich right now? And A, because I think everybody's curious, what happens, when times are so tough for most people. And B, because I want to know who they are so I can hang out with them.
People who got rich, well, if you were smart enough to short the market a few months ago, you are mighty rich, but I wouldn't. No, I don't know anybody who's running around smiling. I mean, maybe some people got lucky and happened to have a short on the market at the right moment, but I don't know anybody who, I mean, I looked in my crystal ball a year ago and say, oh man, this doesn't look good. But that somebody could say on September 15th or whatever the date was, the market is going to completely melt down and just keep heading south. I don't know anybody who predicted that. So I think there are people who are less unhappy than others, but I don't know anybody who's really in great shape. I do think, well, I'll reiterate some of the advice I have. If you have a job, be grateful and don't quit.
Let's thank Steve.